Hello friends, let's understand different types of market risks involved in business and why do these risks occur and how we can hedge against those risks. Fundamentally, market risks occur because of the market forces. As we know, in economics, the fundamental basis for deciding price of a commodity is basically demand and supply. The higher the supply, it is likely that the price will fall, and more the demand, it is likely that the price will rise. We have to understand that individual firms in a marketplace are something called a price taker. They have no control on the market risk. But each of these market risks has a huge financial impact. And the market risks faced by the business, they depend on various things like the nature of business. For example, if you are in commodities business, you are exposed to commodities risk. If you are in banking, you are more exposed to interest rate risk, etc. I have classified market risk into 5 broad categories. Number 1, competition. Number 2, interest rate risk. Number 3, currency risk. Number 4, commodity risk. And number 5, equity risk. Let's understand each of these in detail. Number 1, competition risk. Competition risk come because we have competitors in the marketplace vying for the same set of customers. A new competitor coming into the market with, let's say, huge capacity will disrupt the current players in the market. Example, when Reliance Jio came in the market with lot of capacity in telecom, then others got impacted very severely. A new substitute product coming up, for example, we have a classic case of the digital cameras coming up, and then those who were producing the films, they got that business getting obsolete. Any kind of improvement in technology and being brought by the competitor in the market, they can maybe sell a better product at a lower price, or they have deep pockets. This can give rise to a very cutthroat competition, which is basically a market risk. If there is a low barrier to entry, if anybody can get into this business and they can easily set up shop and start selling, then that's a case of a high risk because of the competition. In the competitive marketplace, the big players weed out the smaller players. For example, we have seen in the food and grocery delivery business, the delivery platforms, the smaller shops which are set up, let's say the app-based businesses during COVID, a lot of them got closed down because the big players have a lot of funding available with them. So this is the kind of risk we face, and it is attributed to competition. The number 2 market risk is arising out of the interest rate movements. Interest rates are also called yield in the financial world, and yield changes because of the forces of demand and supply. Money is like any other commodity. Higher the availability of money, the cost of money or the interest rates typically go down. If the supply of money is less than, let's say, demand for money, then the cost of money will go up. And central banks all over the world play a very key role in determining the money supply through something called the monetary policy. For example, because of the recent inflationary pressures globally, even the central banks in US, UK, etc. increased their interest rates because they had very high level of inflation getting into double digits. Even in India, the RBI had to increase the interest rate, which gives rise to the higher cost of funds in the market. For example, those who have issued bonds based on floating interest will have to now pay higher rate of interest to the people from whom they have borrowed by issuing the bonds. Likewise, while your cost of funds is going up, the valuation of the existing bonds is going around in the market because the bond prices have an inverse relationship with the yield in the market. One of the examples of a very high interest rate risk is the SVB bank collapse in US in the 2023 first quarter. Because of the high interest rates scenario that occurred in US in 2022, the valuation of the bonds or the treasuries held by the SVB bank dropped by about $16 billion, leading to the bank's collapse. How can we hedge interest rate risk? We can use instruments like interest rate swaps, for example, or you can have a call or put option on the bonds if the company is issuing the bond. The next or the third important market risk is currency risk. Currency risk happens because you are dealing in your products which are on the raw material side or on the finished product side in different currencies. And therefore, it typically impacts importers and exporters directly. Since most of the global trade even today happens in US dollars, the USD risk versus your local currency is basically what is your currency risk. For example, for an importer in India, any increase in the rate of USD versus INR is a risk because they have to pay more for the same products. Likewise, for the exporter, depreciation in USD means they will get less money when they are exporting in USD. Typical examples are oil companies in India which are importing oil and paying in the USD, and IT services in India which are exporting to, let's say, US or Europe customers, and their contracts are denominated in USD. How can you hedge currency risk? You can buy currency forwards. You can enter into currency futures contract. They are available on, let's say, National Stock Exchange as well. Or you can enter into currency swap agreements with the counterparties who have the opposite kind of a risk. The fourth important market risk is the commodity risk, which is basically around non-availability of commodities or around the price of the commodities. And it typically impacts those companies which basically consume those commodities or which sell commodities in the market. For example, if there is a rise in the price of a commodity, the consumers get impacted adversely. If there is a fall in the price of the commodity, the producers get impacted adversely. Various examples we can look at. For example, coal is used for manufacturing thermal power. So if the coal prices increase, the profitability of the thermal power plants can go down. Crude oil is used in the refineries which sell oil. So therefore, if the crude oil prices go up, then the refinery's profitability will come down. Bauxite is used in manufacturing aluminium. So if, let's say, bauxite price goes down, then the aluminium producers will benefit, but the bauxite manufacturers will suffer the risk. Iron ore is used in manufacturing steel. So if the iron ore price goes down, the mines will suffer, but the steel manufacturers will benefit. How do you manage commodity risk? You can also hedge these risks by using something like commodity forwards or commodity futures, or at times there are also commodity swaps that can be done, swapping one commodity for another and maybe in the future swapping it back. The fifth important type of market risk is equity risk, which comes out of fluctuations in the prices of the equity. As we know, typically equity is an instrument which gives high reward, but there is a higher level of risk involved. So which means that the fluctuation in the prices of equity are typically higher than, let's say, as compared to treasury bills. The portfolio value will go down. If you are invested in equity and the equity prices go down, your portfolio will go down. If you have lent against equity as a collateral, the collateral value goes down and therefore your risk increases. For example, if the company's equity price goes down and they want to issue equity and raise more funds, let's say near future, they might have to postpone the raising of the funds. So these equity risks are mainly faced by the participants in the financial markets and by investors. But as I gave the example, in case of a company whose equity price has gone down, it can also impact the corporates directly. How can we hedge the equity risk? We can do, we have calls and put options on the liquid listed stocks on, let's say, NSE, BSE, etc. And we also have futures in those particular stocks. So these you can use to manage the equity risk in the short term. Understanding these kind of risks will help you understand market risk better and also hedge those risks and also plan your career in this area. I hope you found this video useful. If yes, please do like this video, share with your friends and also subscribe to my channel. Thank you very much. Cheers.